Question 3. On 1st January 2018, Pathy acquired 70% of the 1.5 million 1 Ghana cedi shares of Sabina for 3 million. When the retained earnings were 1 million, the carrying value of the net assets were equal to their fair value except an item of non-depreciable land with fair value of 800,000 above its carrying value. At that date, the fair value of the non-controlling interest was 1.2 million. It's group policy to measure non-controlling interest at fair value at the date of acquisition. On 1st July 2022, Pathy sold half of its holding in Sabina for 3 million. The net assets of Sabina at the date of disposal were 4,140,000. The goodwill assessed to be 40% impaired. The residual holding of 35% has a fair value of 3 million and leaves the Pathy group with significant influence over Sabina. Calculate the profit or loss on disposal in both the individual and group financial statement and comment on the 35% retained investment. So in this question, we are looking at disposal where the parent loses control. We know control is lost because parent had 70% holding and sold half. Half means it sold 35% and therefore it's only left with 35%. Now, this what is left is below the control mark, which means the boundary has been crossed. The critical boundary has been crossed. So this is where I'll say things like something extraordinary has happened. Something extraordinary has happened. So now here you have to calculate, but if you were to explain, you have to explain that the sale of half has led to the crossing of the 50% boundary or barrier. The parent has lost control of the subsidiary and as such must de-recognize the subsidiary. And de-recognizing the subsidiary means the parent must de-recognize the net asset of the subsidiary, the goodwill of the subsidiary, and any non-controlling interest. So these three items must be de-recognized because consolidation brings subsidiary, goodwill, non-controlling interest. So once control is lost, there must be deconsolidation, which means the subsidiary must be de-recognized. And if you talk about de-recognition of a subsidiary, it means you are de-recognizing the net asset of the subsidiary, the goodwill in the subsidiary, and any NCI related to the subsidiary. And so that's what the disposal is about. And then the remaining interest, which is 35, we are told gives significant influence, and therefore it must be accounted for by the provision of IAS 28. IAS 28, investment in associates and joint ventures. As such, the entity must apply equity accounting method on the remaining 35%. Applying equity accounting method means the investment will be initially recognized at cost, which is 3 million, the residual holding. And then subsequently, the investment will be increased or decreased by the investor's share of post-acquisition profit. Any distribution in terms of dividend will reduce the value of the investment. So That will be an explanation. That will be an essay. But here you are asked to calculate the profit, which means you are just going for the figures. So let's see how all that will play out. So the requirement is to calculate both the profit or loss on disposal in the individual financial statement, individual as well as the group financial statement. So in the individual, you take the sale proceed and then the cost of the investment disposed of. Remember, they disposed of half of the investment. And so in the question, they acquired the investment 3 million, but only half was disposed of. So that half is 1.5 in terms of cost. And they sold, the sales proceed is 3 million. And so the profit on disposal is 1.5. If tax is in the question, you calculate tax in the individual financial statement, and it's the same tax figure you report in the group financial statement. Now, when it comes to the consolidated financial statement, you then take the same sales proceed. Let's take this off. Your sales proceed is still the 3 million, but in addition to that, the investment retained, the 35% investment retained. So they sold 35% for 3 million and they retained 35% with the value of 3 million. So you put all of them together and you can see that the total of this gives you the 70%. But you are showing that they sold 35% and they retained 35%. Okay, and now the investor has lost control, parent has lost control of the subsidiary. So you must de-recognize the carrying value of the subsidiary that has been disposed of. And like I explained, that is made up of the net asset at disposal, the goodwill, the unimpaired. Remember in the question, 40% is impaired, so this will be 60%. And any NCI that is in the question, they constitute these three figures, they constitute the carrying value of the subsidiary, which must be de-recognized. Guys, I'm choosing my words. You have to de-recognize the subsidiary because the parent has lost control. Now, to de-recognize the subsidiary means you must de-recognize the net asset of the subsidiary, the unimpaired goodwill in the subsidiary, and any NCI. And so that is it. You have been given the net asset in the question, but you were not given the unimpaired goodwill, you were not given the NCI. So you have to calculate it. And we all know how to calculate goodwill and NCI. So here you have your NCI at disposal, and there you have your goodwill. Okay, so we all know how to calculate it, so we will not spend time on that. If you don't know how to calculate goodwill, then you have to do that. If you don't know how to calculate the NCI at disposal, then you have to do that. And so once you know your net asset, the unimpaired goodwill, and then the NCI at disposal, the net asset plus goodwill minus NCI gives you the carrying value at disposal. That's the carrying value of the subsidiary at disposal. You deduct it from these, the 6 million, and then you'll be left with profit on disposal of 2.6. This 450 has to be the tax from the individual financial statement. So remember that you are not going to take the tax, you are not going to calculate the tax on the 2664. but rather you must first work in the individual financial statement and determine the tax before you report that in the group. And so that is for question 3. For question 4, like I indicated, now this is goodwill at acquisition, and then at reporting. So this is how you determine the unimpaired goodwill which is reported in the group disposal, right? So in terms of question 4, I brought it for you to see the difference between sale, sale, where the parent has lost control, which is question 3. And in question 4, it will be sale where the parent still has control, and you are to explain. And so you have to indicate that the sale of the quarter bonus are sold quarter of his shares. The sale of a quarter shares is equal to 20% sale, and that still leaves bonus the parent with 60%. So we have 80%, 20% sold, and now we have 60%. Now 80% is control, 60% is control. So in this transaction, that's what I often describe as nothing extraordinary has happened. So it will be considered a transaction among equity holders and accounted for within equity. No profit, no loss. Any difference between what the parent receives because they sold, what the parent received, and the value of what was sold will be accounted for as a difference in equity. So you either debit or credit other components of equity. Now, let me tell you something. Here, the parent is selling, and the parent is selling part of its subsidiary. Part of his subsidiary. So you must take the net asset of the subsidiary and the goodwill of the subsidiary and then sell a part of it. So in this case, we are selling 20% of the subsidiary. So you first of all determine the net asset of the subsidiary, which is 1,200,000 plus the goodwill, which is 880, and then 20% of this value is being sold. That is what is happening here. So always remember what is being sold. The parent selling part of his subsidiary, and the subsidiary is made up of the net asset and the goodwill in it. And so that will be it for question 3 and question 4. The rest is for you to sit back and go over these questions. Thank you.